So guys, firstly I want to apologize for my voice. I have been a little bit sick the last couple of days, but I really wanted to make this video explaining one of my entry confirmations. What is an entry confirmation? Entry confirmation for me is a last trigger before I enter the markets. So firstly I build bias, then I find the supply and demand zones, and then the last thing I need is an entry confirmation is what needs to happen before I click the buy button? What's the last confirmation I need to see before I click the buy or sell button in the markets? So here, once again, you can see my Miro board. I think it's the easiest way for me to express my thoughts and educate you guys on how I do the things the way I do it. And if you never understood how to properly use liquidity plus fair value gaps, I will tell you why they are so good, why they make sense, and how to use them. So here you can see the liquidity sweep plus the fair value gap. And why is it good? It's simply because it gives you high risk to reward. Every time I see this entry confirmation, this specific entry confirmation, I have little to no drawdown if the price eventually goes into take profit. It avoids you from taking false signals and being the liquidity in the markets. And it has a hidden institutional logic behind it. This exact entry confirmation helped me make a lot of money in the markets, some of them being $24,000 and passing funding challenges, also $39,000 in 4 minutes trading gold, okay? On the other hand, here is how your typical entry strategy looks like. You know, it uses a bunch of indicators, it forces emotional trades, it gives you small gains, it has lack of context, and you're basically being trapped in retail entry confirmations that make you the liquidity and lose trades. You will only succeed in trading if your entry is simple, such as liquidity plus fair value gap. Your entry, like I said, your entry confirmation needs to be simple, but also be systematic, but it also should make sense, right? Liquidity plus fair value gap, you need to trade with a higher time frame bias. You need to look for range, equal lows and equal highs. You need to wait for a fast liquidity grab, then retest of a fair value gap, and then you need to enter on the retest of your bias. Step one, I will give you a step-by-step breakdown on how to use it. Step number one, for this specific entry confirmation, you need to have a bias. If you want to trade longs or shorts, do it however you want to do it. If you want to build your bias on different things, build your bias on different things. This is how I do it, okay? So if you use your bias in a different way, that's okay. You can probably apply that to that as well. For me, I look at weekly, daily, and 4-hour charts. I look for higher highs and higher lows. I look at a higher time frame market direction, okay? So first I identify bias if I want to buy or sell. Step number two, I need to find a range of the price consolidation. What is a range? Is basically a repeated equal highs resistance or equal lows support. So here you can see the equal highs resistance and equal lows support. That's what you need to look for on lower time frames. The main key factors for this is you need to look at 1 to 5 minute time frame. It needs to have at least 3 highs or lows. So here you can see 3 touches, 3 touches. Because if it's only 2 touches, there is not enough liquidity below. It needs to have at least 3 touches, or at least it's coming from my experience. If you find it working with 4, 6, or 1 touch, it's on you. I'm just again showing my example. It also needs to go together with a higher time frame bias. What do I mean by that? It needs to be with a bullish market structure. So if your higher time frame, if your higher market structure, higher time frame bias is bullish, then you need to look for liquidity below, right? And if your higher time frame trend is lower, then you should be only looking for sells, right? I will explain that a little bit in the next steps. Now let's go lower. Step 3. After you found your range, you need to identify your liquidity zones. What are the liquidity zones? So when you are in the range, you have this resistance and you have this support. What does that mean? That means on lower time frames, sellers are entering the market here, here, and here, and the buyers are entering the market here, here, and here. What does that mean? If sellers are entering the market here, their stop losses is somewhere above this level, which means the liquidity is above. And if the buyers are entering the market here, what does it mean? Their stop losses is below somewhere here, or in other words, liquidity is somewhere below, okay? So liquidity is where many stop orders are likely to sit. Below equal lows, right? So here, or above equal highs, which is right here. Let me go to the next step. Step number 4. After you identify the equal highs and after you identify the equal lows, and you kind of have an understanding of, okay, there is liquidity above and below, you need to wait for liquidity grab. What is a liquidity grab? Liquidity grab is a quick breakout out of that range and going back into the range. If it happened quickly, it means we grab this liquidity so we can push and continue to push the price higher, okay? So now if, let's say you were looking for sells, then you want a quick breakout to the upside and then break back into the range. And that's what we call a liquidity sweep or liquidity grab. Now, in the step number 5, you need to, it's the last step, okay? And it will get more clear once I show it on the chart. You need to find a fair value gap. A fair value gap is a small zone left behind by a fast move up where price didn't trade much, okay? So basically like an imbalance, okay? Here you have the small candle followed by an impulsive candle, and then we have a big fair value gap. You want a fair value gap that price will come back to during the retest. Why? Because it adds more confidence. So here, if you're looking for buys, so you say your higher time frame trend is bullish, the price broke out of the range to grab this liquidity. Here it created a fair value gap. Now we move to this side. You want the price to break out of this, come and retest this fair value gap, and this is where your entry confirmation will be. And this is where you enter the market, okay? Now, step number 5+1 is just I want to give you an understanding of where to put your stop loss. Now, if I go back here, you have three stop loss scenarios, okay? You can go very aggressive, place your stop loss right below the fair value gap. Medium aggressive would be below the equal lows, and the safest option would be below the liquidity grab. So aggressive, A, here medium aggressive, and then here it's safe. So we have 3 stop loss options, okay? Tight below and above fair value gap zone, medium below or above the nearest market structure low high, and safe below above the previous liquidity sweep highs. So I will show you on the charts what it means. Now, we're looking at 5-minute gold chart, and here what you can see is the trend is clearly bullish, okay? So I'm only looking for buys in this scenario. Now, once I zoom in, what do I see? I see that the price is creating equal highs here and equal lows here, okay? What does that mean? That means that sellers are entering the market here and their stop losses is above, in other words, liquidity, and buyers are entering the market here and their stop loss is somewhere below, which means the liquidity is also below. Now, I don't really want to pay attention to what's happening here. I don't need a liquidity grab to happen to this side because I'm only looking for buys since the higher time frame market structure is bullish. I only want to look for a liquidity grab to the downside, okay? Grab this liquidity of the equal lows, and then we can move forward. So identified equal highs and equal lows on a higher time frame bullish market. I need a liquidity grab to happen, which happened right here. So we have these equal lows. The price went below, took this liquidity here that was laying below, okay? And as you can see, if you can even confirm yourself if that is valid by the reaction the markets had to it, okay? So we formed these equal lows, we grabbed this liquidity, and we have a very strong reaction to the upside. That's like, okay, we did find liquidity here. We have enough liquidity to push the price higher. Now, the last step is for you to identify the fair value gap for you to trigger your entry. Now, some of the people would trade right after the price breaks back into the range after you see the liquidity grab and the reaction. And that would be right as well. If that works for you, you can use that. I like to get more confluences, right? The last confluence I need is the fair value gap. And the fair value gap that I see is right here. As you remember, if we go back to the chart, right here, right? You have this wick, very strong move, and another wick to the upside. Here, you have the wick, strong move, and another wick. So this is going to be your fair value gap. What other thing that I notice is for an even extra confluence, right? I can pull out my Fibonacci from swing low to swing high. Well, let's see where the swing high takes us. So here is going to be your swing high. And the fair value gap also aligns with discounted price of my Fibonacci retracement, okay? So that's going to be my entry confirmation. If the price pulls back into this level, then I'm more than happy to take this trade. I can use the stop loss below the fair value gap, below the equal lows, or do the safe option below the liquidity grab. And then, I don't know, you can shoot for, let's say, 3.5 risk to reward. That's going to be my entry point. Boom. I got triggered in with this touch. As you can see, it rejected the fair value gap. It rejected the 705 Fibonacci retracement, and it went straight into profit. It went even crazier into profit. So as you can see, my entry confirmation, one of entry confirmations, I have much simpler entry confirmations such as double bottom and change of market structure, you know. This is more advanced. This is more complex entry confirmation, but as you can see, it works really well. One thing that I want to mention is these do not happen very, very often, especially if you're trading just one asset. If you're trading 5, 6 multiple assets, it may happen quite more often, but you need to follow each and one of those steps, because if you start going around the charts and looking for equal highs without the higher time frame bias, or you don't actually wait for a liquidity sweep and those fair value gap retracements, you may get tricked many, many times. If you follow each and every step that I just showed you, you're gonna find a lot of success. I recommend you to go and backtest this and see the power of this entry confirmation. Now, if you don't have a specific entry confirmation that you follow for each trade, if you don't know how to find a bias in the markets, if you don't have a systematic approach to trading and do it like step by step, you will not be successful in trading. That's exactly what I teach in the Hidden Edge. In the Hidden Edge, I teach you how to find bias, how to find liquidity zones, how to find entry confirmations, and do it in a repeatable, systematic process so you can find a consistent analysis and then achieve consistent results. If you want to join Hidden Edge, watch me trade live every day, join an amazing community of traders, click the link down in the description, book a call with my team, and I'll see you on the other side.